very respected speaker and senior member of our profession, CA Ramakrishnan sir from Chennai, participants of this evening program. Very good evening to all of you. I deem it my proud privilege to join once again with the elite professional gathering for the seminar on taxation of real estate transactions, which is one of the important subject to all of us, more particularly for all the practicing chartered accountants. Dear members, for today's program, the large number of members registered for a larger participation in all our programs is always a high point that keeps us in SIRC always alert to the needs of our members. I therefore extremely feel happy to offer our grateful thanks and a warm welcome to all the participants for this excellent program. Today we have with us here Ramakrishnan sir from Chennai to speak and share his knowledge and expertise and experience relating to taxation of real estate transactions. On behalf of SIRC, I welcome him for this excellent program, and thank you so much, sir, for accepting our invitation and addressing us. C. Ramakrishnan sir is a graduate from Madras University, a fellow member of the Institute of Chartered Accountants of India, and a graduate member of the Institute of Cost and Works Accountants of India. He has a record on the academic front, having secured ranks in the both university level and CA intermediate examinations. He has about 30 years of post-qualification experience in handling direct tax appeals up to the tribunal stage. He heads the tax compliance and litigation practice in his firm. He has represented a number of complicated tax disputes, which are widely reported in various tax journals and websites, including the top 100 income tax ruling released by Tax Sutra and CCH. He also handles the family settlements, arbitration matters, and consultancy services to various corporates and multinational companies. He is also representing cases under the Prevention of Money Laundering Act, Prohibition of Benami Transactions. He is a member of many professional associations like Chartered Accountants, including he is the former chairman of the Southern Regional Chapter of International Fiscal Association. He is the convener of Chennai Chapter of Income Tax Settlement Commission Bar Association. He is the former president, Chennai ICAI Bar Association. With these few words, I am very much happy to introduce CA Ramakrishnan sir to the elite viewers. Thank you so much, sir, once again. Now over to you.
Thank you for your kind words, Chairman. It is a privilege to address the elite SIRC members, and I thank you for granting me the privilege of this opportunity. Dear friends, the topic for today is taxation of real estate transactions. This is a very important subject for all practicing chartered accountants and also as individuals who transact buying or selling properties, as the taxation laws are made stringent over a period of time in order to curb the black money in the real estate transactions. The evolution of the black money curbing provisions started with 1972 with the introduction of Chapter 20A in the Income Tax Act, which was then called as the competent authority to what we call approve property transactions, and where they felt that the property sale is undervalued, it was acquired by the government. And this provisions of the Chapter 20A from 269A to 269S was there from 15/11/1972 to 30 September 1986. And these provisions were replaced with another set of provisions called the appropriate authority from 1st October 1986 till 30 June 2002. Again, these chapters, that is Chapter 20A and 20C, were removed from the statute because it caused quite a bit of procedural delays in transactions getting completed and also caused hardship to taxpayers. And with effect from 1/4/2002, provisions have been rationalized. In today's presentation, I would take you through the provisions of 50C, 43CA, and section 56(2). (56)(2), 10, 80 IBA, which is actually incentive granted to the real estate business. Section 269 SS, again another provision curbing or making the real estate transactions avoiding cash in the business. Section 23(5), wherever deemed income, and section 45(5)(a). This would be the scope of today's discussion. To start with, as I earlier said, prior to the introduction of 50C, the provisions of 52 of the Act enabled the assessing officer to refer a property and under transfer to the valuation officer to determine the market value. And the 52 section had a drawback because this transaction did not apply to transactions unless there were evidence to show that the consideration was understated. And it was also quite difficult for the revenue to prove that something over and above the sale consideration was passed between the transferee and the transferor. So therefore, a deeming provision, as I had said, from 1/4/2003 relevant to assessment year 3/4 and subsequent assessment years was introduced, wherein the apparent sale consideration would be deemed to be the value that was adopted for the stamp duty. And if the actual sale consideration is not less than the stamp duty value, then the actual consideration would be adopted. And if the actual consideration is less than the stamp duty value, then the stamp duty value would be adopted. This is to prevent the menace of black money, which involves unaccounted cash being circulating in the real estate business. So again, in order to safeguard the menace of entering into backdated sale agreement for lesser value and all, the second proviso of this section was introduced. Similar provisions was introduced because 50C was covering only the capital gains and not where the land or immovable property is held as stock in trade. So there was no provision to govern assets which are held as stock in trade, and for this purpose, section 43CA was introduced with effect from assessment year 14/15 on similar lines with the 50C. So this chart would make it clear as to the similarities and the factors distinguishing 50C and 43CA. More or less, both these sections are on similar lines, and the only main distinction is that for 50C, the asset has to be held as a capital asset, and for 43CA, it has to be held as stock in trade. So the charging point was if the sale consideration, actual sale consideration, is less than the stamp value, then the section deems that the stamp value will be the deemed consideration for the purposes of computing the income, whether as capital gains or as business income. And it would cover immovable properties, whether land, building, or both. The next development was that the first proviso was introduced that the stamp duty value as on the date of agreement to sell would be allowed instead of the date of actual registration when both are different or falling within different assessment years. So this is to mainly protect the genuine transactions where the real estate transactions usually, if it is not concluded within the speed or the essence of the agreement, it can have its own litigation and take many years to resolve. And if, for example, agreement to sell is entered into and an advance is paid, and for some reason the seller is not willing to, or the buyer is not willing to conclude the transaction, a specific performance suit can be filed, and this can travel up to the apex court for whether the specific performance can be enforced or not. And there would be a time gap between the actual registration and the original agreement when the intentions were to complete the transaction. So in order to protect genuine transactions, the first proviso was introduced in 50C, and a similar provision in third proviso in 43CA was introduced. So this proviso said that the stamp duty value as on the date of agreement may be taken for the purposes in computing the full value of consideration, and these had certain conditions to be satisfied for this beneficial proviso to be implemented. That a part of the consideration which is stated in the agreement should be received by the seller by account pay check or any other electronic mode through the banking channels on or before the date of agreement for the transfer. So this is stated in the second proviso in 50C and similar proviso in 43CA as fourth proviso. Then another proviso called the third proviso was introduced, where the stamp duty value does not exceed, originally it was 5%, then later on increased to 10%, when the variation between the stamp duty value and the actual consideration of the transaction, if they brought in a tolerance limit, so that if it is falling within the tolerance limit, then the deeming provision would not attract and the actual consideration can be deemed to be the fair value of the consideration. So similar provision was introduced as the first provision in 43CA. So this tolerance limit was that the Finance Act 21, with effect from 1/4/2021, provided that the 10% to be increased to 20%, and this gave a specific period of time for the transaction, with that between 12th November 2020 and ending on 30 June 2021. If the transaction takes place, instead of 10%, the 20% can be substituted. This is applicable only for a first time allotment of the residential unit to any person, provided the consideration does not exceed 2 crores. This is only in 43CA to give some kind of relaxation for the builders during the COVID period. So this is similar provision is not applicable in the capital gains, because capital gains is not usually a person in the real estate business usually offers the income as business income and not under capital gains. So therefore the relaxation is given only for the business income and not for the capital gains. And reference to valuation officer, this is again a kind of a built-in safeguard mechanism in order to protect genuine transactions. So what happens during a real estate sale transaction is that where the sale value for stamp duty purposes is higher and the actual value of the transaction is lesser, the differential stamp duty is required to be paid by the purchaser. And for some reason, the purchaser files an appeal before the stamp duty authority, disputing the valuation by the stamp duty authority, or if the seller claims before the assessing officer that the value adopted for stamp duty purposes is not correct and the matter requires to be sent for valuation, then the assessing officer has to refer the matter to the valuation officer, who would determine the value of the property, and the value so ascertained by the valuation officer, if it is less than the stamp duty value, then the value so ascertained, the lesser value than the stamp duty value, would be substituted as the sale value for the computing the capital gains. And if for some reason the value adopted is higher or equal to the stamp duty value, then the value so adopted or arrived by the stamp duty by the valuation officer, not exceeding the stamp duty value, will be adopted as a sale consideration for computing the capital gains. So the choice is that where the buyer disputes the stamp duty value, or if the seller makes a claim before the AO for making the reference to the stamp duty value for valuation officer, both the cases the valuation or matter may be referred to the valuation officer. This is again a curative provision where the built-in safeguard for protecting genuine transactions, and the reference where though it says the AO may refer, whenever a claim is made by the assessee who has sold the property, or the value so ascertained by the stamp duty authority in appeal by the purchaser, whatever value that has been adopted, that has to be considered, and the word may here shall have the meaning as shall. And this is a safeguard mechanism, as I had stated earlier, and this is to be availed wherever there is a dispute by the assessee, because this claim has to be made before the assessing officer, and if the assessee loses the chance before the assessing officer, it is quite difficult for the matter to be referred to the valuation officer for the first time to be made in the appellate proceedings. So the claim has to be made during the assessment proceedings whenever the need arises, and not thereafter. Even if the assessing officer, after a claim is made, does not refer and adopts the stamp duty value without referring to the valuation officer, there are quite a number of decisions in appeal. The matter is remanded by the tribunals to the assessing officer to make the reference to the valuation officer, and the value ascertained thereafter by the valuation officer is to be adopted for computing the capital gains. So this slide shows the meaning of the valuation officer, which is still holding good even though the Wealth Tax Act is no longer in force. The meaning given, or the definition given under subsection 2R, subsection R, would be the definition, which is the valuation officer to whom the reference has to be made. And the provision also had a development under 50C that previously the section said wherever the value is assessed under the stamp duty authority, a higher value assessed by the stamp duty authority. Subsequently, the word was introduced, value assessed or assessable. The word assessable is introduced because in a case that is covering 247(5), where possession is handed over and registration has not taken place, registration is getting deferred to a later point of time, but by in view of the provision 2 subsection 47(5), the capital gains incidence of transfer has occurred in the year of granting possession, in part performance of agreement to sell. In all those cases, the stamp duty value would not be assessed because there won't be any registration in the year of transfer. So the word assessable was introduced in the section. Again, for 43CA, the word Residential unit is also defined, which means an independent housing unit with separate facilities for living, cooking, and sanitary requirement, and distinctly separated from other residential units within the building. So all these definitions are given in the section because the law over a period of time has evolved and developed to be covering all aspects, so that the misuse or abuse of the provisions using ambiguity in the definitions is not happening. Again, the valuation report submitted by the valuation officer is binding on the assessing officer, and after receipt of the valuation report, the assessing officer cannot substitute his own judgment. This view has been taken by the Gujarat High Court in the case of Principal CIT versus Rajivji Bai, Nagji Bai, reported in 388 ITR 358. And the word assessable, which I had said, would cover where there's a transfer but no registration has taken place. So more or less 43CA and 50C are on the similar lines, and the major difference is that one would attract capital assets and the other would attract stock in trade. And there are quite a number of decisions which are rendered in 50C because it is an older provision, which would apply to cases of 43CA, because most of the transactions and the wordings in this section are similarly placed. I would take up a few issues which are commonly occurring for the benefit of the practitioners, which are held by various high courts. So these are the commonly asked questions. That first issue is that whether 50C is applicable in case of transfer of property by way of gift, will, merger, or any other mode. This section 50C is applicable where there is a transfer and of an immovable property in which consideration is received or accrues to the transferor. So the transfer by way of gift, will, or an irrevocable trust or partition of SUF is not regarded as transfer under section 47. Therefore, section 50C will not apply to these transactions. Whether 50C is applicable in case of transfer of rural agricultural land. 50C is applicable where there is a transfer of a capital asset. So section 2 subsection 14 of the Act says that the rural agricultural land is not a capital asset, and therefore the transfer of a rural agricultural land would not apply, would not be applicable for a transfer in the first place, and therefore consequently 50C is also not applicable. However, if an urban agricultural land, that is within the limits, say or municipal limits specified in the section, is there, the transfer of urban agricultural land would attract the provisions of section 50C. Whether the provisions of section 50C is applicable on transfer of building being a depreciable asset, where a building is used for the purpose of carrying on the business, like a factory building or like a cinema theater or various other buildings, which is entitled for the claim of depreciation. This also would be getting covered under 50C. This view has been held by the ITIT Mumbai in the case of Smita Conductors Limited. However, section 50 will also be attracting. So both 50C and section 50 would get simultaneously attracted for this provision. Whether the tolerance limit of 10%, which is prescribed by the third proviso in 50C, would have a retrospective effect. This amendment of the third proviso, by prescribing original tolerance limit of 5% and 10% thereafter, would apply from the date of introduction of 50C which is 1/4/2003, relevant to assessment year 3/4. This view has been held by the ITIT Mumbai in the case of Maria Fernandez Cheryl, reported in 123 taxman. So this, again, this view regarding the retrospectivity applicability has also been concurred or held to be applicable from assessment year 3/4 in the case of Chandra Prakash Junjunwala by the ITIT Kolkata, saying that it is a curative provision and it should have a retrospective applicability. The next issue is that can 45(3) and 50C apply simultaneously? See, 45(3) is a special provision which was brought into the Act from 1987-88 to overcome the tax avoidance or abuse by persons entering into a partnership by one bringing in a property and the other bringing in money, and the value for the person who brought in the property, a value is credited in his capital account. And the general law that the partnership firm and the partner are not different was made use of, and they claimed that the transfer is not happening when the partner contributes a capital asset to the firm. So in order to plug this kind of abuse, section 45(3) was introduced, and also 45(4). 45(4) is at the time of dissolution or otherwise, which has been very much enlarged in this Finance Act 2021 by introducing section 9(b) and 45(4). Quite a bit of amendments have happened. But when it comes to 45(3), when a partner contributes a capital asset, the 45(3) deems that the amount recorded in the books of the partnership firm shall be deemed to be the full value of consideration received or accruing as a result of transfer. And 50C says wherever there is a transfer of a property, whether registered or not, because it uses the word assessed or assessable under the stamp duty, then the stamp duty value would be adopted as the sale value of consideration. Whether both these provisions can be applicable simultaneously, or whether one would prevail over the other, is a very moot question which has come up in a quite a few number of decisions. The courts have, or the tribunals and the courts have held that one deeming fiction cannot be extended by importing another deeming fiction. Again, while interpreting the provisions of the statute which has a deeming fiction, another deeming fiction cannot be superimposed. Thus, section 45(3) and section 50C operate in different spheres and cannot have an overlapping effect. This has been held specifically with reference to 45(3) and the 50C in the case of Kirti Reddy Venkat Mohan Reddy by the ITIT Hyderabad bench, and in the case of Amartara Private Limited by the ITIT Mumbai bench. Though the apex court has held that one deeming fiction cannot be extended to another deeming fiction, which was the base for deciding both these decisions in CIT versus Moon Mills Limited 59 ITR 574. So 45(3) is a special provision which governs a transaction between a partner and the partnership firm. So, which is a special provision, therefore the special provision would prevail a general provision. 50C is a general, though it is called a special provision governing immovable transactions. Though the title or the section heading says it is a special provision for immovable transactions, 45(3) is a special provision for a particular segment of transactions, that is partner and the partnership firm. So that would supersede or that would prevail, and 50C would not be applicable in such transactions. This is the view that has been adopted in the case of Sarang and Ashok by the ITIT Chennai bench, that 50C would not override 45.3, and 45.3 would be the section that would be applicable for transactions between a partner and a partnership firm. So this is something which I would say would be applicable for the person transferring the asset, for the taxation in the hands of the partner, that whatever value that has been given credit for in the books of accounts of the partnership firm would be deemed to be the full value of consideration for computing capital gains. However, this has a effect of the differential value getting taxed in the hands of the firm after the operation of 56.210, where it enlarged the earlier 56.27B to be applicable not only to individual or HUF, but covering all persons defined under the Income Tax Act. So the decisions of Kirti Reddy, Venkat Mohan Reddy or Sarang and Ashok covers only the aspect in the hands of the transferor or the person to whom the capital gains is accessible, and not in the hands of the recipient, because that part has now been totally plugged by the provisions of 56.210. Then, whether the word accessible inserted in the section can be applied retrospectively. Though 50C was introduced with effect from assessment year 3-4, the definition of original definition was adopted or assessed was the words used in section 50C. Thereafter, the word was enlarged to use the word assessed or accessible. So the accessible brought in, and the scope being enlarged to cover the other kinds of cases which were hitherto not getting covered, and therefore it has been held by various judicial decisions that the amendment is effectively prospective and not retrospective. This has been held by the Madras High Court in the decision of CIT versus Sugandha Ravindran, reported in 32taxman.com 274. Also, the CBDT by circular number 5 dated 3/6/2010 has specified that the amendment is prospective in nature. The next issue that has cropped up in various decisions are that whether the first and second proviso specifying that the value as on the date of agreement, where the date of agreement and the actual transfer falls in two different assessment years, whether the date, the value as on the date of agreement is to be adopted. Again, this provision is a curative provision to remove difficulties for genuine transactions, and hence it has been held to be effective from the date of introduction of section 50C. This view has been held by the Madras High Court in the case of CIT versus Ummadi Amarendran, reported in 120taxman.com 171. The next issue that has come up in 50C is, in case of the stamp duty valuation as on the date of transfer is less than the stamp duty valuation as on the date of sale agreement, because some years back the Tamil Nadu government had revised the stamp duty valuation downwards, the guideline value downwards, and basically the downward revision was effective from a particular date. So whether there's an option with the assessee to consider the lower stamp duty valuation for applying 50C. See, the insertion of the proviso was done by the legislature to enable the assessee to adopt lesser stamp duty value prevailing as on the date of agreement, and the terminology used in the first proviso is value adopted, assessed or accessible by the stamp valuation authority as on the date of agreement may be taken. So the reduced value, if the original value, stamp duty value, though here the key point is that the actual transaction value should be lesser than both the stamp duty values. That is at the time of sale agreement and at the time of registration. Therefore, the stamp duty value, whichever is lesser, that is at the time of agreement or at the time of registration, whichever is lesser can be adopted. But if the transaction value is higher than both of them, then the transaction value only has to be adopted. This view of whether the option to adopt either of the stamp duty value has been held by the Ahmedabad bench of the ICAI in the case of Dharmshi by Sonani, reported in 161 ITD 627. One more issue that has come up is if claim raised by the assessee under 50C is not considered by referring to the valuation officer, whether the addition is sustainable based on the stamp duty valuation. So, as I had stated earlier, though the word used is may, it has to be interpreted as shall, and this view has held by various tribunals and courts, and matters have been remanded to the assessing officer to get the matter referred to the valuation officer, and consequently assessments being framed by getting the correct value. Where the stamp duty value of the property is considered in case of equity shares of a company owning the property transferred. See, what happens is, in some cases, the company may own an underlying immovable property without any other business or assets, and there was some kind of tax planning. Instead of buying the property, the transaction used to be happening by transfer of the equity shares of the company which owns the immovable property instead of the property being transferred. So prior to the introduction of section 50CA, there was no specific provision to plug this tax planning, so-called tax planning. But subsequently, with effect from assessment year 1819, valuation rules have been introduced. Rule 11 UAA has been introduced, wherein the unquoted shares will have to be valued by taking the stamp duty value of the underlying property as on the date of transfer. So this mechanism of transfer of shares instead of the transfer of property also has now rationalized by adopting the stamp duty valuation of the immovable property underlying in the unquoted shares. So the issues that require further consideration is that how can claim be raised before the AO that the fair market value of the property is less than the stamp duty value. So the sale value considered, if it is less than the stamp duty value, there is no specific column in the return of income where the sale consideration can be specified, because there is no specific claim that can be made in the return of income. However, where the assessment is taken up, whether it is under the faceless scheme or under the physical assessment scheme covering search or survey cases, the specific claim can be raised by way of a letter in writing to the concerned assessing officer just before or during the assessment proceedings. The issue that requires another where there is quite a bit of various decisions or conflicting decisions on this is whether 50C is applicable on transfer of development rights. There are quite a few decisions by Mumbai ITAT in the case of Bharat Raoji Patel, Arif Akhtar Hussain, saying that 50C is applicable for development agreements. And while arriving at this conclusion, the ITAT held that development rights in respect of property is a capital asset involving an immovable property, and thus the sale proceeds is chargeable under capital gains in the hands of the landowner. Therefore, 50C is applicable. Again, in specific cases, the Mumbai ITAT has also held that 50C is not applicable for transfer of development rights in the case of network construction company and Voltas, where the tribunal had distinguished, saying that the capital asset transferred was development rights in the land and not the land itself. So these kind of conflicting decisions are there, and the law is not settled until now. The next aspect is real estate transactions involving in the hands of the purchaser or the recipient, because capital gains and the stock and trade involved only the taxation in the hands of the seller. The hands of the purchaser, similar provisions for rationalizing the value in order to again plug undervaluation of transactions, so that the purchaser also adopts the correct value, because originally before introduction of 56.2.7 or 56.2.10 as it stands now, there was no provision that was taxing the purchaser of a property, whether undervalued or not, for consideration. Those separate exclusions are provided under 56.2 for transactions between related parties. So in order to plug the abuse by undervaluing property transactions, this section was introduced. Earlier, before this introduction of section 56.2, gift tax was in vogue till October, that is 30 September 98, where the recipient was taxed, not the recipient, the donor was taxed the gift for making the gift. Then from 110.98, the donor based taxation was removed, and the donee, that is the recipient based taxation, was brought in. This was brought in to achieve a dual objective of one, the gift tax did not achieve combating tax evasion, and it did not yield substantial revenue. And in order to avoid the misuse of the exemption wherever gifts are there, the 56.2.10 was introduced, and clause 5 was introduced under 56.2, where initially the amount was 25,000, and it covered individual or HUF only. And if somebody receives a gift of money or immovable property, then it was taxed in the hands of the recipient if it is undervalued or if it is for no consideration. Subsequently, with effect from 1/4/2007, the limit of 25,000 was increased to 50,000. And again, from 1st October 2009, receipt of immovable property or any other property, either without consideration or a consideration less than the stamp duty value, was brought to the tax net. And with effect from 1/6/2010, clause 7A was introduced. Then 7B was introduced from 1/4/2013, and with effect from 1/4/2017, it was enlarged, because either till 2017 it was covering only individuals or HUF, and with effect from 1/4/2017 it was covering all assessees, where the assessee receives an immovable property without consideration or a consideration less than the stamp duty value. The differential between the stamp duty value and the actual transaction value, or wherever it is received without consideration, has been brought to tax in the hands of the recipient. So this chart would simplify and explain that the section is applicable to any person, and there should be a receipt, and it should be from any person or persons, because you may have multiple gifts or multiple transactions in a year, and the date is on or after 1st day of April 2017. I am avoiding the first part because the first part here, subsection A covers or subclause A covers only money. The second part, B, covers any immovable property, one, without consideration, where the stamp duty value exceeds 50,000, then the stamp duty value would be taxed as income from other sources. Next, for a consideration lesser than the stamp duty value, then the higher of 50,000 or the actual difference. Now that actual difference is again you have a tolerance limit of 10% brought in with effect from 1/4/2021. The excess of such amount would be brought to tax in the hands of the recipient. So where it does not exceed 50,000, then it gets ignored. Where it is 50,000 and more, the excess amount shall get taxed, subject to a 10% tolerance for the consideration. This tolerance limit of 10% will be applicable retrospectively because the pronouncements in 50C has held that the tolerance limit would apply retrospectively. So the same analogy can be adopted for 56(2)(10)(b). Again, 56(2)(10)(b) has a few provisos which are similar to 50C and 43CA. This is just a similar kind of safeguards or to mitigate genuine transactions getting affected, that where on the date of agreement the value is stamp duty value is lesser, then that value can be adopted instead of the value as on the date of registration. Again, the second proviso gives the conditions for the entitlement of the first proviso, that the consideration as per the agreement should have been passed on by banking channel, whether account pay, check, draft, or electronic clearing system. So on or before the date of agreement. So therefore, 50C, whatever was applicable to 50C, 43CA on these transactions would equally be applicable for the purchaser. Another interesting provision is that wherever the higher value was adopted by invoking 56(2)(10), whenever that property is being sold at a later point of time, then the cost of acquisition under section 49(4) gets substituted by the higher value which was adopted for the purpose of 56(2)(10). So this is only again to mitigate the difficulty that whatever has been already taxed, you get a deduction on that. Though the rates of taxes are 20% for a long-term asset and 30% for a short-term asset, and the purchaser would be first paying 30% as income from other sources. It depends on the period of holding, but still it is a small mercy that has been shown for giving the benefit of the cost of acquisition for the deemed value that has been already assessed. The third proviso is similar to the valuation officer reference in 50C or 43CA. So where the property is referred to the valuation officer, again here also the purchaser can make a request for reference for valuation officer, and whatever is applicable under 50C would also be applicable for this provision. And again, there's a fourth proviso there. This is the 10% and 20% tolerance limit depending on the period, because the COVID period there is a 20% benefit given. Wherever that has been applicable for the seller, then similar provisions would be applicable for the buyer of the property as well. There are certain exclusions for 56(2)(10)(b), which are transactions between relatives or on the occasion of marriage of the individual, or received under a will or inheritance, and various other irrevocable trust or all other means. So the word relative is also defined under the section itself. Therefore, all these are the exclusions to the applicability of section 56(2)(10)(b). Again, though 56 to 10B is applicable to capital asset, immovable property being land or building or both is one of the definition of property that is covered under 56(2). And again, stamp duty value is also defined under the section. The relative is also defined to exclude the spouse and the lineal ascendants and descendants of the individual, and the spouse of the lineal ascendant or descendant specified, and in the case of a HUF, the member thereof. So these are the exclusions, and the exclusions are clearly defined under the provision itself. Now I would take the concession or the benefit that is given to the real estate developers or the builder community, as they are commonly known. This is given because the construction industry is one of the largest employers in the private sector, apart from the organized employment given for various service industries or whatever manufacturing industries. So in order to promote low cost housing or affordable housing, section 80 IBA has been introduced. The main challenges is that the real estate prices are being skyrocketing over a past few years, excepting I would say last 2 years. There's been quite a lull in the real estate industry, and therefore the government has increased the tolerance limit from 10% to 20%. So before that, whatever construction was done, it was catering to the upper strata of the society, because the builders were not keen on providing or constructing affordable housing, and the government, in order to promote affordable housing, sanitation, and a safe environment for the citizens, wanted to give an incentive to the real estate developers, who otherwise would be paying 30% on the profits earned on construction. So 80 IBA was introduced to provide a deduction to the extent of the profits derived from the business of providing affordable housing. The word affordable housing has been clearly defined by saying that the business of developing and building housing projects, and the housing projects has also been defined. The deduction shall be equal to 100% of the profits and gains derived from the business. So what is the residential housing project which is eligible? All these have been defined in the section itself. It's a self-contained code for availing the deduction for on the profits and gains of providing or constructing affordable housing. The conditions are as under. First, the project should be approved by the competent authority or the development authority who's supposed to give the planning approval after 1st June 2016, but before 31/3/2021. The year 2021 has been substituted by 2022 by the Finance Act 2021. So again, there is another condition where the approval in respect of the housing project has been obtained more than once. The date of the first approval will be taken as the date of approval of the project. Then there is a condition that the project has to be completed within a period of 5 years from the date of approval, and this means the date of first approval. And the completion is deemed to be completed when a certificate of completion is given for the project in writing by the competent authority. This is to evidence that the project is completed in all respects, inspected and certified by the competent authority. Then only the project is treated as completed. Then the definition of commercial establishments and shops. they have a cap of 3% of the aggregate carpet area of the entire project. Next, what is the minimum size of plot on which such development has to happen? In respect of specified cities, the land area should be not less than 1000 square meters, and in the case of any other place, it is 2000 square meters. And the project is the only housing project in the plot of land. Next, what is the carpet area of the residential unit? In the specified cities, the carpet area is specified as 30 square meters, and in the other cities or any other place, it is 60 square meters. So it should not exceed. And the word carpet area is also defined. First, they define what is the size of the residential unit, and then they define what is the meaning of the carpet area. So further conditions are that where a residential unit of the housing project is allotted to an individual, no other residential housing unit in that project should be allotted to the same individual or the spouse of the individual or the minor children of the individual. So this is one of the important conditions. Therefore, this condition would not be the converse, is that if the property is purchased in the name of the major children of the individual, or if the property is purchased by the parents of the individual or the spouse of the individual, then the condition of non-entitlement of deduction will not be hit. So it can be sold to the major children or the parents or parents-in-law of the individual. Then after 1st September 2019, they also brought in another condition that the stamp duty value of the project should not exceed 45 lakh rupees. So the stamp duty value of the residential unit would mean both undivided share of land and the construction cost, and would also include other amenities like car park and various other things which comes along with the purchase of the residential unit. This is again to plug the misuse of the deduction by pegging the value of the residential unit as less than 45 lakhs and collecting monies as various amenities exceeding 45 lakhs. So the total value should not exceed 45 lakhs. Again, what is the floor area that has to be, floor area ratio that has to be maintained in the project? It should be less than 90% in the specified cities and less than 80%. And floor area ratio permissible in respect of the plot of land as per the rules made by the central government or state government or the local authority, as the case may be. So the subsection 2 requires maintenance of separate books of accounts in respect of the housing project, and this also requires that the person who is carrying out this housing project should be a developer and not a contractor. That is subsection 3. See, all these were there in the erstwhile 80 IB, which is the original section which granted deduction in respect of all housing projects for a certain period of time. However, 80 IBA restricts only providing the deduction in respect of affordable housing with the floor area and everything specified in the section. Further, the provisions of 80 AC also shall apply, where it says that the deduction shall not be allowed unless the return of income is furnished on or before the due date specified under 139(1). So if a belated return is filed then the deduction under section 80 AC is not applicable. However, if a revised return is filed and the claim has been made in the original return, or not made in the original return and made in the revised return, there are cases that has held that if the original return is in time, the deduction is allowable, whether through the revised return and fresh claim or an enhanced claim is made. However, the original return should be filed within time. Section 4, subsection 4 of 80 IBA specifies that the project should be completed within a period of 5 years. And wherever the project is done over a period of time, that is involving a number of assessment years, then the deduction shall be allowable in each of those years within the period of 5 years from the date of the first approval, if the completion is done within the period of 5 years. This is because as per accounting standards and ICDS, now the construction contracts and similar projects have to be, revenue has to be recognized as percentage completion method, and therefore the profits would be recognized over a period of time. So therefore, in order to enable the deduction being claimed over a period of time, subsection 4 enables that, but subject to the overall completion of the project. So though you make the claim in each of the assessment years, if the project is not completed within the period of 5 years, then the claim made in the earlier years would automatically be not allowed. So subsection 5 says where any amount of the profits and gains is claimed and allowed under this section for any assessment year, you cannot get another deduction for the same amount under any other provision of the Act. So this is only to plug a double deduction for the same profit. So the carpet area, competent authority, floor area ratio, housing project are all defined under the subsection 6 of 80 IBA. And to subsection K of RERA, which defines carpet area, has been adopted for the purpose of the definition that has been borrowed from that Act, RERA. The competent authority, say it is the authority who is empowered to approve the building by any law in force, whether it is the central, state, or local authority. Then floor area ratio, a specific formula is given. It is the quotient obtained by dividing the total covered area of the plinth area of all floors by the area of the plot of the land. So a mathematical formula has been prescribed here. Then housing project is also defined, meaning a project consisting predominantly of residential units with other facilities and amenities as may be approved by the competent authority, subject to the provisions of this section. Where why subject to provisions of this section is there is a cap of 3% of commercial area and shops. So if that exceeds, even though the competent authority approves, the project may not be eligible for deduction. So though the project may be approved by the competent authority for more than 3% of commercial area, if it is less than 3% of the commercial area only, the deduction can be claimed. Again, a rental housing project also is defined as a project which is notified by the central government in the official gazette. So residential unit is also defined. All these have been defined specifically because in the earlier avatar of 80 IB, each one of these points had various litigations traveling up to the apex court in some on some issues, and therefore in the new avatar the Act has become a self-contained code defining each and every word in the section to avoid any ambiguity and for better understanding of the provisions. Again, stamp duty value is the value adopted, assessed, or assessable. So it covers all the three aspects. This is only for arriving at the 45 lakhs cap for the residential unit. Further, definition of housing project is given under subsection 6D of ICAI. This is given to determine the eligibility for deduction under section 80IBA. So housing project means a project predominantly, as I said earlier, predominantly of housing units which with such other facilities and amenities as may be prescribed by the competent authority subject to the provisions of this section. Because in the earlier avatar of 80IB 10, there was no clear-cut definition of a housing project. And in the case of Veena developers, the matter traveled up to the Supreme Court, and the Supreme Court gave the meaning as provided in common parlance, where it exceeded the specified area of facilities and amenities. So, in order to avoid any ambiguity, the definition of housing project is also given. Further, the approval granted by the competent authority is the conclusive proof for a housing project, subject to the limits prescribed under this section. Now, what are all the practical aspects that can come up under this 80IBA? Is when one residential unit is allotted to an individual before 1st September 2019, can a second residential unit be transferred or allotted to his parents or major children? As I said earlier, major children and parents of the individual or the spouse can buy. They are not disqualified or by allotting to the major children or the parents or parents-in-law of the individual. The housing project will still be eligible to claim a deduction under 80IBA and it will not be hit by the provisions. Whether deduction under section 80IBA is eligible for dwelling or duplex units or row houses. See here, the definition of a residential unit is specified under 80IBA, which says it should be an independent unit which is distinctly separate from other units within the building. However, dwelling unit or duplex or row houses within the project can also be eligible subject to other conditions. The other conditions meaning the total area should not be exceeding 30 square meters or 60 square meters as the case may be, because 30 square meters or 60 square meters is by itself a small place if it is in one level. So if it is a duplex, I don't know how far it would be feasible to construct like that, but still if it is covering all the other or satisfying all the other conditions, then still if it is a single project and these kind of duplex or row houses are built, they are still eligible. Next issue that comes up for consideration is that if an individual is making a housing project, a specific person, for a specific person, will the deduction be allowed? See, the intention of bringing this incentive for affordable housing is to enable the general public to avail, and if it is built for a specific person, then it is only for a specific person's purpose, and this would be hit by the subsection 3, which says it becomes a works contract. Because when you do it for a particular person, whether it is a central government, state government, or any company or any individual or whatever person, it would not be allowed as a deduction, because you are only carrying out more or less a works contract or a contract for construction. whether it comes with the land or without the land. This section intention of giving this benefit is for the general public to avail housing for better living and for affordable housing for the people who have a dream of owning a house. So normally a builder is a person who has a risk reward function in constructing a housing project. So if it is done for a particular person, then there is no risk reward. There's no risk involved. There may be a reward. The condition of risk and reward will not be satisfied, because the contract risk and business risk are quite different. The next issue that is there is, if the project is completed within 5 years, but flats are sold after 10 years, will the deduction be allowed? See, the deduction is allowed on the completion of the project. It does not state anything relating to the sale of the flats or the residential unit in the project. So for this purpose, if the residential housing units are not getting sold within the 5 years, still the revenue has to be recognized in accordance with AS7 and ICDS 3. And as soon as the revenue is recognized and you get the completion certificate for the project, irrespective of whether the flat is sold after 5 years or 6 years or 10 years, it does not matter. To the extent of the revenue recognized under the percentage completion method and claimed over the period of the 5 years, up to 5 years, would be allowed as a deduction on proportionate basis. So the actual sale, which happens later on, if at all there is an increase beyond the value already seen, it will get taxed appropriately in the year of actual sale. Again, I would be dealing with the deemed income on flats that are not sold subsequently when I take up section 23(5). What if permission is taken after 1st June, but due to some issues, project could not be started and therefore it was scrapped, and in its place a revised permission has been taken from the competent authority for the same project? Will the assessee be eligible to claim deduction under this section? The section clearly says that approval has to be taken after June 1st June of 2016, but before 31/3/2021, though 1 year relaxation is given up to 31/3/2022, and it would date back to the date of first approval if approval is taken more than once. So the project would still be eligible to claim the deduction if the approval is taken after 1st June 2016. Therefore, even if the approval is taken more than once, if the other conditions of completion and apartment size, to whom it is sold, and various other restrictions as to the commercial area, if all the other conditions are satisfied, yes, if it is completed within the period specified from the first approval, the deduction is eligible. Can deduction be claimed in respect of residential unit which the approval is obtained on or after 1st April 2019, where the stamp duty value exceeds 45 lakhs? See, one of the conditions is the amount has to be less than 45 lakhs. So if that condition is not satisfied, then the deduction cannot be availed. So therefore, the primary condition is the sale value should not exceed 1/4/2019. Again, if the apartment is contracted to be sold before 1/4/2019 and the value is exceeding 45 lakhs and money has been received as advance, subsequently the registration takes place after 1/4/2019, this is an issue which would have to be decided by the appellate authorities, though my personal view would be the relaxation or the provisions of equivalent in 50 CE or 43 CA or 56.210, which gave that where the period of date of agreement and the date of registration are falling in different assessment years. That logic can be applied, but however, there is no judicial pronouncements as on date on this aspect. Again, the next question is whether the total value is 45 lakhs, whether this is only for the residential unit and whether allotment of car park and various other amenities, whether that can be separate. This issue has also not been examined, though I would not have a liberal interpretation here, because most of the value for the sale value for the total project as a whole has to be submitted for the purposes of RERA before the real estate RERA authorities. So the breakup of the entire amount to be collected from the customer has to be provided. And while adopting the same value which is adopted for RERA will have to be adopted for the Income Tax Act also. So therefore 45 lakhs limit or the cap, whatever applicable for RERA, which includes the car park or various other amenities, all those would still get covered, and it cannot breach the limit of 45 lakhs for transactions after 1st April 2019. Then this is a small tabular chart which shows the differences between 80 IBA and the old avatar of 80 IB 10. See, basically the differences are the period for the approval, because the earlier section was up to approval up to 2008, and though both the sections had 100% of the profits derived. The commencement of construction is not specified, but the date of approval for the construction construction or the development has been prescribed as 1st June 2016. But under the 80 IB 10, it said all commencement has to happen after 1st October 98. Period of completion, 80 IBA has 5 years, and completion certificate has to be obtained from the competent authority granting the permission for approval. But 80 IB 10 had a different period based on the date of approval, and again the completion certificate, it said the certificate issued by the local authority. Now the words used are the competent authority. And size of plot, again 80 IB 10 said minimum of 1 acre. This has been differentiated in the new section 80 IBA, where the plot sizes of 1000 square meters and 2000 square meters specified in the section. Again, area of residential unit is 30 square meters and 60 square meters. In the other in the earlier section, it was 1500 and 2000 square feet. Area of shops and other commercial establishments does not exceed 3%. The same 3%, but it had a cap of 5000 square feet, whichever is higher. We don't have such a whichever is higher kind of condition in the present section, because this is for affordable housing, and therefore the cap of 3% of the carpet area is the cap fixed. The similar conditions of sale of more than one unit to the same family was there in the earlier section, but the earlier section had HUF also included. The present section has individual spouse or minor children only. Allotment of residential unit to non-individuals. There's no such provisions whether it can be allotted to non-individuals, whether because the section clearly says it should be sold to people wanting affordable housing, so it can be sold basically to individuals or joint owners, as the case may be. in the earlier section, it said not more than one residential unit is to be allotted to any person not being an individual. So works contract is excluded in both the provisions. So 80 IB 10, which had quite a bit of litigation and a lot of judicial pronouncements by traveling up to the apex court. Since both the provisions, as I had explained in the previous slides, are more or less similar. So the judicial pronouncements which are rendered in relation to 80 IB 10 may also be applicable to 80 IBA as well, insofar as the similarities are considered. So some of the issues which have come up is will the deduction under 80 IBA be allowed in relation to additional income? Because in the earlier sections, the introduction of 50 CR, 43 CA, all these things are because of the prevalence of black money in the real estate sector. So what happens when you declare an additional income in the return in response to 153A, a search conducted and then subsequently proceedings under 153A initiated. So additional income is disclosed at the time of search, whether the deduction will be allowable under 80 IBA. In the case of Malpani Estates, the Pune bench of the 80 in relation to 80 IB 10 said the deduction shall be available to the additional income offered under section 132(4) and filed through a return of income in response to the notice under 153A of the Act. So the benefit of additional income is available for the deduction. However, the main condition is that the return of income, original return of income, should have been filed within the due date, because it should not be hit by the provisions of 80 AC. So it can be a enhanced claim under the 153A provisions and not a fresh claim. Though there are decisions for that fresh claim can also be made, but basic condition is that the original return should have been filed within the due date. What if expenses incurred to earn income on which deduction under section 80 IBA is disallowed by operation of various other section like 40A3 or 40A1A? Can the deduction under 80 IBA be claimed in respect of the enhanced business income due to the disallowance? Again, the Pune bench of the ITAT in the case of Magarpatta Township Development and Construction Company has held the increased deduction is allowable. Again, this is also subject to the compliance of the original return being filed within time. The other issue that has come up is that where assessee has completed housing project before the final date, but local authority for technical reasons granted build that is completion certificate or build the building use permission after such date, whether 80 IBA is allowable. So if the application has been made within the time, and again the competent authority has given the completion certificate after a delay, that is after the period of 5 years, then the assessee should not be penalized for the delay of the municipal authority. And the decisions of the Gujarat High Court and Punjab and Haryana High Court support this, that for the delay caused in issuing the completion certificate by the municipal authorities should not come in the way of claiming the deduction under 80 IBA. So the next issue is whether ownership of land is required for claiming of deduction under section 80 IBA. See, this has been examined extensively in the decision of Sanghvi and Doshi Enterprise by the Madras High Court, wherein it was held that the ownership of land is not the criteria to decide that whether a person is a developer or a works contractor. This is because a builder may also take up a project that on joint venture where he is not the owner of the property developed, and he may be taking the risk of only putting up the construction and selling his share of the joint venture. So this issue was examined extensively by the Madras High Court and said the case where the builder is a joint venture agreement holder with the landowner, he's taking a risk element and he is not just a contractor undertaking mere construction, because he would have to build the third and fourth floor even if the flats in the first floor is not sold. So the similar view also can be adopted for claiming the deduction under section 80 IBA. So he would not be hit by the definition of the works contractor, because he's taking the risk, business risk of putting up the construction, irrespective of whether he will be able to sell the flats or not. The same view has been held by the Honorable Gujarat High Court in the case of Mahadev Developers, Prathama Developers, and by the Hyderabad bench of the ICAI in Vertex Homes. Can business loss from eligible business under section 80 IBA be adjusted against any other income? This issue was examined by the ICAI bench of Bengaluru in the case of Sterling Developers, and it said the loss from the eligible business unit under 80, it was rendered under 80 IB10, can be set off against other business income. So there is no bar. If you have a profit, yes, you will be claiming a deduction. But if you have a loss in the eligible business, it can be set off against other business income. And similarly, if you have loss in other businesses, again, the eligible unit has a profit, both have to be netted together, and only the deduction under 80 IB would be restricted to the total business income by operation of the other provisions of 80 AC. And so the next issue is, will deduction be allowed if the assessee follows project completion method instead of percentage completion method? The view of the Gujarat High Court is yes, the deduction has to be allowed. However, this decision would not be very much applicable, because now because of accounting standard 7 and ICDS, you will have to compulsorily follow percentage completion method, and therefore you will have to offer income year on year based on the percentage completion, recognizing the revenue over the period of construction. And as I said earlier, the percentage completion method has to be applied, and the deduction should be allowed year on year, subject to fulfillment of the other conditions, which would be looked at in the last year when the project is completed and the completion certificate is obtained, whether all the conditions have been fulfilled or not. So there's no bar in the assessee claiming the deduction on a proportionate basis year on year. So the next issue or next aspect is, again, going back to the curbing of cash transactions in the real estate business. The section 269 SS was enlarged by the Finance Act 2015 with effect from 1/6/2015, prohibiting the acceptance of advance by way of cash for any real estate transaction or transaction involving immovable property. The need for this was the decision of the Kerala High Court in the case of AM Puzzle, where the court observed that unless prohibition is introduced against cash transactions, particularly in the sale of property in film industry and the like, or prescribing limits in cash, black money generation and circulation cannot be controlled because disincentives on cash dealings contained under various provisions have failed to achieve the objective. So when the court had observed this, the provision has been amended with effect from 1/6/2015, prohibiting acceptance of cash by the seller of the property. The seller of the property can be holding it as capital asset or stock in trade. Irrespective of that, the seller cannot accept 20,000 or more by way of cash. So the section is analyzed like this. Initially, the section was only covering a loan or a deposit. Then the word specified sum was introduced, and the definition of specified sum is also defined under the section that the specified sum is a sum of money receivable, whether as advance or otherwise, in relation to a transfer of immovable property, whether or not the transfer takes place. This is because some people can say that, or whenever there is a search, people try to explain that they have received an advance for sale of a property and try to explain the presence of cash and the premises. So in order to discourage such transaction and penalize people involving such transactions, a penalty under section 269 SS has been introduced to penalize any sum of money received 20,000 or more for a transaction for transfer of immovable property. Even if the transfer does not take place, you receive cash and then the transaction did not take place and you refund the money, it is still hit by 269 SS, and an equal amount of the specified sum, that is the actual value of advance exceeding 20,000 or more, will be levied as a penalty. 269 SS does not define the word immovable property. Therefore, there is no exclusion for rural agricultural land. It does not say capital asset. It does not say stock in trade. It just says a transaction involving immovable property. Therefore, it would apply to all transfer of immovable property, whether it is an agricultural land, urban agricultural land, rural agricultural land, all kinds of immovable properties. So, except to the situation defined in the second proviso of the section, where both the parties involved are having only agricultural income and not having any other income chargeable to tax. So that is the only exclusion provided under 269 SS for non-levy of penalty. Again, 273B would still be applicable for transactions of 269 SS. But again, 273B, I come to that a few minutes later. The penalty is specified under section 271D, which is the equal amount of the amount accepted, and it would be levied in the hands of the person accepting the specified sum. And it aggregate amount means the total money received, not just on a single day, the various instances, everything will be clubbed and the total limit has to be reckoned with. The only exclusion is section 273B, which says a penalty under section 216 SS or 271D, attracting the provisions or attracting the violation of 216 SS cannot be levied if there is a reasonable cause for the failure. What can be a reasonable cause for receiving an advance in cash when the law prohibits? Unless you can explain that you received it as an advance for some reasonable cause, whether medical reasons or whatever reasons, whether you are in a dire states for the need of money, all those things, but still the matter would go and have a process of law, and the penalty has no time limit. This 269 SS or 269T or 269 ST involving penalty of cash transactions, these have no time limit, and these need not arise during the assessment proceedings. These can arise even through the tax audit report whenever it is reported in the tax audit report, or through the AAR or various other modes through which the information is collected by the department. And the time limit is that it can be invoked or at any point of time. But the only exclusion is it should be within a reasonable period of time, not after a long gap between the transaction and the initiation of penalty. The next is a deeming provision in respect of rental income by the land by the construction companies where they are not able to sell the apartments. So the construction of the flats by the builders are held as stock in trade and business assets in the balance sheets, and if they are not able to sell within the period specified under section 23(5), then there is a deemed income that is to be brought to tax by bringing in the annual letting out value as per section 23(1), as reduced by deduction under 24, which is the 30% deduction you get to be taxed as income from house property. The need for this section came up when large amounts of apartments are hoarded by the real estate developers and not putting it up for sale and trying to sell it at a premium by holding it and creating an artificial demand. That is the basic intention of bringing in this provision. However, now with the COVID times, though certain relaxations have been brought in the sale value, this is again the deemed letting out value to be taxed as income from house property is not relaxed. This is only to encourage the builders to dispose of the stock at the earliest and not hoard it. So originally this issue was examined in the case of Ansal Housing Finance and Leasing by the Delhi High Court. It said the notional value has to be brought to tax. So due to this judgment, the builders across the country had to face huge tax demands, and this representation on this aspect brought in the amendment or insertion of section 23(5), where the Honorable Finance Minister void the Finance Act 2017 provided a relief that if the unsold inventory is for 1 year, then the notional rental value will not be taxed. This is only to provide for business exigencies for the builders who are not able to dispose of the stock. And this 1 year has been increased by 1 more year through the Finance Act 2019. So 2 years time after the completion of the project is given for the sale of the property. And if you are not able to sell within 2 years, I think the notional value has to be taxed in the hands of the builders under house property. Otherwise, because they would not, at least by this, they would at least reduce the price and sell and dispose of their stock rather than holding it for a longer period. The next is section 45(5)(a). This is the last aspect I'll be covering in this presentation. The need for insertion of 45(5)(a) was that the timing of taxation in respect of joint development agreements went through a lot of controversial situations as to the time of taxation, whether it is at the time of entering into the agreement or whether it is at the time of selling the undivided share by the builder, or whether it is at the time of receiving the completed flats by the landowner as his share of the joint develop as per joint development agreement. So the Finance Act 2017, with effect from assessment year 18-19, introduced the section 45(5)(a) with an objective to resolve all the controversies as to the timing of taxation in respect of transfer of land to a developer by an individual or HUF being the landowners, by providing that the year of taxability and the value of consideration. So what this section says is that the section simply says that the value of the consideration received by way of the developed property in the year of completion of the project would be deemed to be the consideration, along with the money portion, if any, paid for the to the landowner. And that is, if a part is paid by way of money and a part is given as completed apartments, both put together would be taken as the value of consideration in the year the project is completed. This is only to avoid the taxation of a deeming transfer by invoking 247(5) in case of a joint development agreement, and saying that the possession is granted in year 1 when the joint development agreement is entered into, and bringing the whole thing to tax. So this is only applicable if the property is held by an individual or HUF and a joint development agreement is registered and the land is held as a capital asset by the landowner, and the consideration is received as share of the developed project with or without monetary consideration. So the monetary consideration, if received in the first year when the agreement is entered into, will also be taxable along with the value of the completed apartments in the year in which the completion certificate is issued. So this section starts with the non-obstante clause, saying that notwithstanding, it would be taxable in the year in which the certificate of completion is received or is issued by the competent authority in the year of completion only. It's getting taxed. So this is a great relief for the individuals and HUF entering into joint development agreements, because in the earlier before the introduction of this section, they used to be facing quite a bit of litigation by the year of taxation being disputed and getting stuck in litigation. So there are certain conditions also. Section 45(5)(a) is not applicable where the assessee transfers his share before the date of issue of completion certificate. That is, say for example, 10 flats are totally constructed and 6 flats are allotted for the landowner, the landowner sells the 6 flats before the completion, then 45A is not applicable and it would trigger in the year in which the flats are sold by the landowner, even if it is before the date of issue of the completion certificate. And it is also not applicable when the entire consideration is received only in the form of money. So if the section is applicable only if you receive the consideration partly monetarily and partly by developed a share of the developed property or developed property alone. If it is entirely monetary consideration, then the section is not applicable. Unregistered joint development agreements are also not covered by section 45A. And if it is a stock in trade, then also it is not covered under 45A. So the cost of acquisition for the buyer is provided under 49(7). Indexed cost is also applicable. So the capital gain arising out of transfer of the capital asset being shared in the project in the form of land or building or both, then the cost of acquisition shall be the amount which is deemed as full value of consideration in that subsection. So that is also clearly provided under 45 for the purpose of 45A. What can be the issues that can come up under 45A is the period of holding. Whether the period of holding is to be reckoned from the date of acquisition till the date of transfer to the developer, or till the date of date when the capital gains is chargeable under 45A. According to the provision 45A, the actual transfer is not relevant. The date is to be the date deemed is the date of completion certificate. So, in our opinion, that if the where the year of transfer differs from the year of taxation as per 45A, the period of holding should be computed with reference to the date on which the capital gains is chargeable to tax. Again, exemption under 54BF or EC are all applicable for 45A, subject to the various conditions being satisfied as per 54B, 54F or 54EC. The applicability of 50C2 is not there specifically for 45A. However, my opinion is even if it is invoked, then the 50C2, where the reference to valuation officer can also be made wherever it involves a higher stamp duty value than the fair market value of the property. Then certificate of completion issued for part of the project. As per the mandate of section 45A, capital gain is chargeable to tax even when the certificate is issued for part of the project. Again, in that situation, only the proportionate to the ratio of land vis-a-vis the total project has to be considered. Then whether 45A is retrospective or prospective. The memorandum of objects which introduced this section states that this present amendment seeks to minimize genuine hardship which the owner of land may face by paying capital gains in the year of entering into the joint venture agreement. So there are several decisions which say that the amendment is curative, it will have and to remove hardship, it will be retrospective even though it is prospective. There are quite a few decisions on this principle. However, this is not tested whether 45A can be applicable retrospectively. That has to be tested. So with this, friends, I would come to the end of the presentation, and I would take any questions.
Sir, can we take the questions now, sir?
Yeah, we can take the questions, sir.
So I'll just flash my screen.
Yeah.
So, is my screen visible, sir? My Excel
1
sheet.
minute. 1 minute. Yes, it is visible.
So we have something around close to 11 to 12 questions, and keeps on coming. We'll take it up.
To use the increase in FSA, the number of developers enter into contracts with residents and through their society to construct extra floors in the existing building by paying certain amount to the society as well as to the members. Whether the amount received by the members as well as the society is taxable. Actually, this is this issue is not attained finality because this would come as the development rights being brought to tax. Again, as stated by the queryist, that there are divergent views by the ITIT Mumbai, and this issue has not attained finality. I am informed that these tax case appeals on these issues, both by the assessee and the department, have been admitted by the Bombay High Court. So we have to await for the finality on this. Whether section 269 ST, payment of cash in excess of 2 lakhs, is applicable for sale of agriculture land. Sale of 269 ST is only for sale of goods and services. The immovable property is governed by 269 SS. Therefore, sale of agricultural land, the exclusion provided under 269 SS, where both the parties are agriculturalists and have no other taxable income, could be applicable and not 269 ST. And the limit is 20,000 or more, not 2 lakhs. Third question, immovable property gifted by husband to wife and wife sells within 2 years. Hope the value is the old value of old owner as per section 49(1) read with 242A 47. Is the gain to be treated as long term with indexation benefits? Where a person receives a property by way of gift, and the property is later on sold by the person who received it as the gift, the value as on 1/4/2001 or the cost to the previous owner has to be substituted as in terms of 49(1), and the period of holding will also be enlarged to the period of holding of the previous owner, and it can be treated as long term or short term depending on the period of holding. And indexation will also be applicable based on the decision of Manjula Shah. Therefore, all these would be their period of holding. If it is exceeding the prescribed limits, it would be long term, otherwise it is short term. Short term, you don't get indexation benefits. However, the only catch here is where the property is gifted by the husband to wife. So clubbing provisions would be applicable because the income derived on the property transferred by a husband to wife would be attracted. So that has to be also kept in mind. 28(6)A provides for taxation of notional income arising out of transfer of immovable property from stock in trade to capital asset. Is it constitutionally valid? Because capital asset is converted into stock in trade, the resultant capital gains is taxed in the year of sale. Whereas when the stock in trade is converted into capital asset, the resultant gain is taxed in the same year as business income, though there is no real transfer. The constitutional validity has not been put to test for this section. Though logically, when the capital gains is brought to tax, when a capital asset is converted into stock in trade only in the year of sale, the corollary also may be logical, but equity and taxation don't go together unless it is struck down as not constitutionally valid. Actually, there is no constitutional validity cannot come in here. Whenever it is stock in trade, you will have to value it at cost or market value, whichever is lower. Therefore, still, my view is that the real gain would come in only when you actually sell. The market value of the property has to be adopted in the year of conversion, and it has to be brought to tax. If you don't value it at the market value and value it at cost, then this has to be examined by the courts, and a verdict on this only will give clarity. In the case of a JDA, what is the time of taxation for the landowner? 45(5)(a), as I explained, if the landowner gets only developed property or developed property plus monetary consideration, it would be taxed only in the year in which the project is completed, or in the year in which the landowner sells his share of the developed property under development, whichever is earlier. In one block, can there be more than 45 lakhs flat and less than 45 lakhs flat, and I can get exemption for less than 40? See, the proportionate deduction is not a concept for ICAI. The total sale of a flat should be less than 45 lakhs. So if certain flats are sold for 45 lakhs before the introduction of the subsection which prescribes the limit of 45 lakhs, and subsequently you are selling it less than 45 lakhs, then you may be able to claim both the deduction. But I don't think if you have the sale of 45 lakhs and more than 45 lakhs and less than 45 lakhs in the same year, you cannot get exemption for one part. You'll have to satisfy the condition for all these apartments as a whole. 56(2)(10)(b), the builder completes the project in 5 years but could not sell. This was dealt in my presentation, that in the year of completion he has to reckon the income revenue as per project percentage completion method year on year. So the profit up to the date of completion has to be recognized and deduction claimed. So the this is in relation to 80IBA, but I don't know how 56(2)(10)(b) comes, because 56(2)(10)(b) is in relation to a recipient of the property where it is less than the market value. So I'm not able to understand what is the actual query, but if it is relating to flats not being able to sell, yes, only the revenue recognized as per the project has to be offered and deduction claimed. Later on, whatever the incremental profit comes subsequent to the 5 years will have to be taxed, and no deduction will be available. Project has more than 50 units, few units less than 45 lakhs. This again I had explained. If it is if the sales happen after the introduction of the section, that is after 1/6/2019, then you cannot have less than 45 lakhs or more than 45 lakhs. If the same project had before and after the section limiting the consideration to 45 lakhs, then you can claim. Where a landowner holds a number of unsold flats for a number of years after completion of JDA, can the maintenance charges paid on unsold flats be claimed? See, you get a straight 30% deduction when a notional value is taxed. The maintenance charge paid cannot be part of cost of acquisition or cost of improvement, because the maintenance charge is already taken care in the 30% general allowance that is given for house property. JDA not registered. In that case, should the assessee go back to the original? Yes, it will go back to the original method. Where the completion certificate has not been obtained, will it be enough if the completion certificate is obtained? No, the section clearly provides that the completion certificate has to be obtained from the competent authority who has granted the approval for the project. So it has to be approved. The completion certificate has to be granted only by the competent authority, not by the registered valuer. Is there a flaw in valuer's report? Refer to valuation. What is the remedy? So whenever there is a valuation report by the valuation officer, you can counter the valuation because he would issue a show cause notice before furnishing his report. And if the property has certain infirmities, that it is not enough, it is below the road level, it has got not a perfect shape, it is encroached, various kind of infirmities which a property can have, then in response to the show cause notice, you can reply as to why the value adopted by the valuation officer is not correct. And the valuation officer through his report would dispose of the objections and give the value, and this can be taken up in further appeal. 269 SS is in respect of advances. When the sale amount is total is given in cash after completion of construction, is it any violation? It is a violation because 269 SS clearly says whether received as an advance or otherwise in relation to an immovable property, whether the transaction has happened or not. So it covers all aspects of a real estate transaction, and therefore the sale consideration received in cash would be a violation of the provisions of 269 SS. Whether the benefit of provisions under section 45(5)(a) can be claimed for assessment year 17-18. Again, this has to be put to test because the section has been introduced. 45(5)(a) has been introduced from 1/4, that is 1819. Since the section says that it is curative in nature and to avoid genuine hardship, you can claim. And again, this would be going through the test of appeals. What about the TDS to be made by the builder on for the on money paid? In which year it is to be claimed, whether in the year of completion?
Ma'am, it seems his connection got disconnected. I'll just wait for a moment. Am I audible?
Yeah, you are audible, Selva. Members, kindly wait. There is, I think, some connection problem with the speaker.
Yeah, just check with the speaker, ma'am, please.
Sorry for the interruption. I think there is some issue with the members' connectivity. It will be revived shortly, sir. Sorry for the interruption.
Ma'am, sir said he will be joining in another minute or two, maximum 3 minutes. So there is power shutdown, it seems. So Sir, if you joined from mobile, we'll take the rest of the question and we'll finish it off, sir. One minute. It seems he has joined from mobile. Let me just check. And also, if no.
Sir,
Yes, sir.
able to hear me now, sir?
Yes, I can, sir. Please. If you're able to
So-
see the questions, we can see the last 3 questions can be taken, sir.
Yeah. What about TDS to be made by the builder on the for the on money paid in which year it is to be claimed? See, on money would be paid in cash, so there wouldn't be any TDS on that, and it would be hit by section 40A3. So automatically it would be hit. So therefore the amount cannot be claimed. The next question, sir, can you
Read it out. If agricultural land converted to residential site and sold, whether we can get exemption under section 54B when we purchase agricultural land within 2 years.
Yes, you can, subject to the conditions in 54B, you can get the exemption.
After entering into agreement, the government revises its stamp duty values, which is more than the actual consideration. What would be the value to be considered as sale consideration?
See, the consideration or the stamp duty value as on the date of agreement would be the value adopted when there are 2 different times where the agreement is entered in one assessment year and the transaction is concluded in another assessment year. So, but it is subject to conditions that you will have to pay some. You have to pay some amount of advance in the year in which the agreement is entered into on or before the date of the sale agreement. So only then you will be able to claim the exemption.
Yes, those were the questions, sir. Thank you for.
Thank you. Thank you.
Good for you for.
Sorry that due to power failure I couldn't.
That's okay, sir. That's okay. So on behalf of SIRC, I thank Ramakrishnan sir for a clear view on the topic. Your session on taxation of real estate was very educative and informative. We all learned new areas in real estate taxation. I once again extend my sincere thanks to you and the members viewing. We hope to have you in more session of yours in SIRC. Thank you very much, Ramakrishnan sir, and thanks the member for viewing the program patiently, because I extend my apologies for a break in the last session. Thank you very much. Thank you.
Thank you. Thank you.
Thank you.